All right, welcome back to another session here. So far we've already started talking about financial assets. We talked about asset valuation in general, about how we do bond pricing, about yields to maturities, the term and interest rate structures of bonds. Then we moved on and talked a little bit about the stock market. How do you value equities and the Gordon growth model? And then the last session we discussed what we do with foreign exchange, right? How is an exchange rate determined and what influences where the exchange rate moves around. So now we turn to this second key idea that we had at the start of the course, where we said once we finish discussing everything we wanted to talk about with financial assets, we'll go on and talk about banking in general. So in this session, we'll try to cover everything I want to talk about with banking. So we'll talk about the economics of banking, what the basic operations are, how to construct a balance sheet, and uh, how uh, how to understand the basic operations of a commercial bank and how banks manage risk on their balance sheets, right? The last session is kind of a historical overview of the banking industry in general, and it'll culminate with a brief discussion of what happened during the financial crisis in the banking sector and what kind of uh, programs were put in place to combat the effects of the financial crisis, right? So this will be basically the section where we do everything we around banking, and from in the next, I think 4 sessions, we will cover the institutions which surround the banking system, right? So we'll talk about the Federal Reserve System, we'll talk about how they manage the money supply, and then finally we'll talk about financial panics and crises and what policy tools are available to mitigate them, right? Okay, so as usual, we'll begin with a key question and we'll try to circle back to it at the end of this discussion so we can tie it all together. So, what we've seen, at least over the past 35 years, is that there have been two instances where the American banking system has experienced very sharp bank failures, right? One was during 87, 88, during the savings and loans crisis. We'll briefly discuss what happened then. And then, obviously, what happened in 2007, 2009, where there was a wave of bank failures around the US, right? So, at least from our understanding of the financial crisis, most of the big banks stayed intact, right? If anything, they got bigger from forced acquisitions and mergers and so on and so forth. But there were a couple of high-profile bank failures. But what is left unsaid there is that there are a lot of small banks, small community banks and credit unions, which were severely distressed that they had to shut down, right? So the spike that I'll show you in the graph in a couple of slides shows you that, there's a lot of bank failures, but not a lot of them are well covered in the financial press. But there is one amazing bank called Abacus. So if you are interested, there's a frontline documentary about the Abacus Bank. It was a Manhattan-based community bank, and you see what uh, happened to them during the financial crisis. To date, it's the only bank whose CEO was charged and actually served a prison term for what they did during the financial crisis. So if you're interested in that, take a look at the documentary. I'll send out the link to the documentary when I send out this video as well. Okay. So the question uh, is banking inherently a risky business, and what kinds of risks do banks face, right? So to answer all of that, we need to first understand how do we evaluate the position of a bank, the financial viability of a bank, and then what we use generally is to look at the bank's balance sheet, right? So, in its very core conception, a bank is a fairly straightforward business model, right? A feature of a bank, especially a commercial bank, is that it takes in deposits and then makes loans using those deposits, right? So, uh, it's bringing together savers and borrowers in the economy. Like we said, was one of the key ideas behind the financial system is that it eases the transaction, right? So there is a middleman there. The borrowers don't have to go looking for a saver. The savers don't have to look for a borrower. They can just go to the bank. Savers who have excess cash can go to the bank, deposit their money. The bank keeps these deposits in trust and uses those deposits to find borrowers and make loans out to them, right? So the primary source of funds are obviously deposits for a bank, but there are other ways that the bank can raise funds, and we'll talk about that. Okay. So balance sheet essentially gives us a snapshot at a point in time of the overall financial situation uh, of the bank, where it takes tells us all the assets that the bank owns and all the liabilities that the bank owes. Right? And the typical layout of a balance sheet is based on a very simple equation that the liabilities, right, the assets that the bank owns should be equal to the liabilities that the bank has plus bank capital, right? Bank capital is also called shareholders' equity. This is what owners of the bank's interest is in the uh, in the structure of the bank. So here's a typical balance sheet. This is a consolidated balance sheet for US commercial banks. It's from 2016. So the Federal Reserve collects all of this data and they release it periodically. So this one is from June 2016. And here we can see how a typical balance sheet is laid out, right? So on the left side of the balance sheet, we have, here, let me just get a pen. So on the left side of the balance sheet, we list all the assets that the bank owes, right? These are, as I said, an asset is anything where you have a financial claim on somebody else for payment. So these are assets in the sense that this lists all the different kinds of financial claims that the bank has on other people. On the right hand side of the balance sheet, we list the bank's liabilities. This is what the bank owes, right? And finally, if you look at the last line item on the liability side of the balance sheet, there you see what we list as bank capital or shareholders equity. Okay, so let's just quickly run through the key elements on the asset side and the key elements on the liability side and get a understanding of what it looks like. The first key asset that we list, usually when we list the assets on the uh, balance sheet, it's listed in order of liquidity, right? The most liquid assets are listed first and then the less liquid assets and so on and so forth. Generally speaking, that's the convention that's used in accounting. So, if you've taken a course in accounting, all of this should be familiar ground. If you haven't, we're not going to get into the details of how this is constructed, but to just get a brief understanding of what a balance sheet looks like and what the idea is and what the logic is, right? So the bank obviously has reserves and cash assets, right? It's a bank, so it holds some amount of its assets in the form of liquid cash. So if you look at US commercial banks, about 10.6% of all their assets are held in the form of cash. Okay. Now, other than that, the bank can also hold some of its assets in the form of securities, right? Securities are, it either is equities in the publicly traded stock market, or it can buy US treasuries and so on and so forth. So here, if you take a look at it, 22% of the bank's assets are in the form of securities. And here's a kind of a small breakdown. And about 4.4% is in just US government bonds, right? These are US Treasury bills and bonds of varying maturities and durations. And about 12.5% of the bank's assets are in the mortgage-backed security market. And when we say MBS, when we're talking about mortgage-backed securities, these are mortgages which are made out to homeowners in order to purchase a loan, and they're all packaged together and securitized and then are sold on to other investors. Right? So about 12.5% of the bank's assets are held in the form of mortgage-backed securities. And then about 5.1% in state and local government securities, so state bonds and local municipal bonds. We already discussed why you might want to be in the municipal bond market because of the tax treatment, the preferential tax treatment that municipal bonds have, where they're not exempt from paying both federal taxes and state taxes and sometimes even local taxes, right? So between the US government treasuries, the mortgage-backed securities, and the state and local government securities, you have basically the breakdown in all the different kinds of securities that the bank has, right? Again, remember, the security is just a financial claim which can be traded, right? Because these are things that you can buy and sell at will in a public market. And now, it is listed in the form of securities. The biggest asset, obviously, that the bank has is the loans that it makes up. About 58.8% of the bank's assets are in the form of loans. Why is a loan an asset to the bank? Because the claim is from the bank on somebody else for payment, right? When a bank makes out loan, it lends you money, it has a financial claim on you. So it's an asset for the bank and a liability for you, because the claim is on you. It's a liability on your balance sheet. But from the bank's point of view, it's an asset because they have a claim on somebody else for paying. As you can imagine, a commercial bank's primary business is to make loans, and about 58.8% of its assets are in the form of loans. And here we have a quick breakdown of what kind of loans does a typical commercial bank hold. Right? About 12.3% is in the commercial and industrial sector. These are loans which are made out to firms to buy equipment, to finance inventory, and so on and so forth. About 30% of it is in real estate, right? This includes commercial mortgages, right? About 9.7 is in the form of consumer loans, right? So you can get a personal loan, or if a bank is in the credit card business, this is where all of that is consolidated. About 9.7% of the banks' loans are in the form of consumer loans. 1.2% is in the form of interbank loans. As the name suggests, these are loans which one bank makes to the other, right? So banks themselves lend and borrow from each other, and we'll see why they need to do that, right? This is a crucial element of understanding what is known as the repo market, the repurchase market, and the repo rate, right? So when we talk about benchmark interest rates in the economy, we already discussed that there is such a thing called the federal funds rate. The federal funds rate is basically determined inside what we call the repo market. The modern incarnation of where we discover what the federal funds rate is in the repo market. And we'll talk about what a repo market is, what a repurchase agreement, repo is just short for repurchase agreement, what that entails, and why we need that market to function properly. And then other loans make up about 6.5%. So as you can imagine, 58.8% of the bank's balance sheet assets are held in loans, of which between commercial, industrial, real estate, and consumer loans, that takes up the bulk of the loan portfolio that the bank owns. There are other trading assets, and there might be other assets that the bank owns. We'll take them in detail, but that basically gives you a quick breakdown of what the asset side of the bank's balance sheet looks like. The other side of the balance sheet is obviously what the bank owes, right? The liability side, right? Now, the biggest liability on a commercial bank is the deposits, right? So when I make a deposit, when I open up a bank account and make a deposit at a bank, I immediately I have a financial claim on the bank, right? So it's a liability from the bank's point of view, an asset from the individual's point of view, right? So about 74.8% of the bank's liabilities are servicing deposits, right? 12.1% in checkable deposits. This is what, is checking accounts or negotiate order of withdrawal accounts. And about 62.7% are in non-transaction deposits. Okay. So non-transaction deposits, these, you can think of these as savings accounts and other savings instruments where you can't write a check against the savings account. You write a check against your checking account, but most people hold most of their cash inside a savings account, an interest-bearing account of some kind, and then the rest is held in the form of checking account. So between your checking and savings accounts, most of the deposits that the bank owns most of the liabilities that the bank has is in the form of deposits. Okay. The other big liability on the bank is the borrowing that the bank does itself, right? So the bank might need to borrow money in order to finance its own transactions and its day-to-day operations and business. And usually this is what we call the commercial paper market. And so about 8.2% of the bank's liabilities are in the form of borrowings that it has done. There's other liabilities, and whatever is left over is bank capital, right? About 12.7% of the bank's liabilities are owed to its shareholders. Right? This is the equity portion of the bank's balance sheet, right? So where does this come from? So, when you're setting up a bank, a few people get together, they pool their money together and start up the bank, right? So their money is tied up in getting the bank set up and started, and they hold ownership stakes in the bank. And about 12.7% of the bank's liabilities are in the form of this kind of bank capital. Right? Other shareholders. So if you want to buy a share in Bank of America or Citibank or JP Morgan, you can just go to your brokerage account and actually buy a share in them, and that gets added in here in the form of bank capital. Okay. So here's a big brief overview of what a typical balance sheet looks like. So the key things to understand here are, you list the assets on the left-hand side of the bank. Assets are usually listed in the order of liquidity. On the right side of the bank, we list the liabilities that the bank owes and the bank capital, what is shareholders' equity. And the fundamental accounting equation which holds everything together here is that assets always need to be equal to liabilities plus shareholders' equity. Okay. And in a fundamental sense, it is straightforward, right? Because what this identity is telling us is that whatever the bank owns, at the end of the day, it is owed to somebody else. It's either owed to in the form of liabilities to the depositors in the bank, or it is owed to the owners of the bank in the form of equity, in the form of shareholders' equity. And that's where that fundamental identity comes from. This is basically what balances the books, as we say. Yeah, if you have some mismatch between the left hand side and the right hand side, then you have an issue here on the balance sheet because something is not getting accounted for. Okay. All right. So the basics of commercial banking. Straightforward, asset is anything of value that an individual or firm owns. And when we talk about assets in our particular context, we're talking about financial claims on somebody else. Liability is something that an individual or a firm owes. Again, this is in the form of financial claim on an individual or a firm. And the bank capital is the difference between the value of the bank's assets and the value of the bank's liabilities. Right? And usually we want to think of this as the difference, because whatever the bank owns, first of all, it needs to be able to service all the liabilities it has already incurred, right? So the depositors need to get their money back. So if I liquidate all the assets of the bank in the order of, if I take everything that the bank owns and sell it completely off, all the money that I pull together, it needs to get distributed back to all the people I owe money to, right? That makes fundamental sense. And the first order of business is obviously to return the money to the depositors. And then I need to service any other kinds of debt I've incurred. And then if anything is left over, that's what accrues to the owners of the bank. If there's nothing left over, then there is no bank capital, right? So in a philosophical sense, it's better to understand bank capital not as some line item on the bank's balance sheet, right? This is once you get up to this line, you look at the total assets of the bank, you add up all the value of the total assets of the bank, you add up the total liabilities of the bank, take the difference between those two, and that tells you what bank capital is, right? This is basically what balances the books, the difference. All right. So let's look at the liabilities of the bank first. So this is a slightly more detailed discussion of what we already covered previously. So we'll take each of those line items on the liability side first, then we'll take each of the line items on the bank's on the asset side of the bank's balance sheet, and then discuss them as well. Okay. So again, just keep this in mind, and we're like just ticking off each of these line items here. The first liability that we discussed was checkable deposits, right? Checkable deposits, as the name suggests, is any account against which you can write a check, right? If you write a check and you give it to somebody else, when they present that check to the bank takes money out of that checking account from against which that check was written, and then gives it to the person presenting the check, right? So there is a small difference, a very minor difference. So there is what we call demand deposits. As the name suggests, these are deposits which can be withdrawn on demand. There is no gap, right? There's no transfers. There's nothing. If you show up to the bank and say, I want this amount of money and it's in my checking account, it should be made available to you immediately, right? So that's what it says, is that it's a demand deposit. And on demand deposits, the bank do not pay any interest. On a checking account, there is usually no interest. And the reason why people are willing to forego interest is for the fact that it's instant liquidity, right? You're getting compensated for no interest in the form of instant liquidity. You want cash, you get cash immediately, right? So that's the reason why banks don't pay any interest on demand deposits. The other kind of checking account, which is not that fashionable, but you'll still see it here or there, is what we call a now checking account, which is called a negotiated order of withdrawal. Okay. So these are checking accounts that pay interest. And these are basically out of fashion now. Most checking accounts carry zero interest, but there are still some banks which, in order to incentivize people to open bank accounts with them, might pay a small interest rate on their checking accounts, but it's fairly minor. Okay. But the crucial thing is obviously that checkable deposits are liabilities to the bank because the bank owes this money to the depositors, and it's an asset to households and firms which have opened these accounts. Right. The second kind of deposits that the bank takes in, which is the second kind of liability that the bank has, is what we call non-transaction deposits, right? So when we talk about non-transaction deposits, the usual suspects are here: savings accounts. So these are not accounts against which you write checks, right? These are accounts where you just hold the money there in that account till you need it. If you need that money, you take that money out of your savings account, transfer it into a checkings account, and write a check against the checkings account, and that's basically what you do. So you can't directly conduct transactions with the money that you hold in these accounts. So savings accounts, money market deposit accounts, time deposits, as the name suggests, is where you deposit money with the bank and you're not allowed to withdraw that money for a specified period of time. And for the reason that it's locked up for a particular duration, it usually carries a higher interest rate than what you would get on a savings account, right? And certificates of deposits. Again, the certificates of deposits of varying maturities, we've already discussed what those look like, right? So both checkable deposits, everything which is in a checking account, and small denomination time deposits are insured. And they're insured by what we call the Federal Deposit Insurance, the FDIC. So when you see banks, they'll have a little thing where they say they're FDIC approved, which is to say that they take out an insurance contract where the bank pays a small premium every month relative to a portion of the deposits that it holds into this common pool of money, right? And if a particular bank gets distressed and goes under, that pool of money is used to reimburse the depositors of the bank, and up to $250,000. So the Federal Deposit Insurance is a guarantee that up to $250,000 of cash is completely uh, uh, redeemable, in the sense that if you hold anything under $250,000 in a checkings account or a savings account or a small denomination savings account, if the bank goes under, there's a government insurance program where the government steps in and makes those depositors whole, and you don't lose any of that money. And this is a way to give consumers confidence to leave their money in the banking system, right? This makes sure, so you don't have to ever worry about your bank going under or going out of business or being financially distressed. There is this insurance program which acts as a backstop when the bank is in distress. Okay. All right. The other liability on the bank's balance sheet, so that's the big one, obviously. So we talked about deposits. That's about 75% of the bank's balance sheet, and it's in the form of deposits. So let's talk about what these borrowings that the bank has. Okay. So banks often generally, when they make loans, they make more loans than they can finance with funds that they attract from depositors, right? So how do they manage to do this? So they have to borrow money to finance some of these loan transactions, right? So bank borrowings include short-term loans in what we call the federal funds market. We'll get to that in just a second, what the federal funds market is. It might also take loans from the bank's own other subsidiaries and overseas branches and so on and so forth, and other affiliates which operate under the umbrella of the bank's charter. The repurchase agreements, the repos, we'll talk about that also in a second, and discount loans that it can take from the Federal Reserve System, right? So Federal Reserve System has what we call the discount window. So when you read about the discount window in the financial press or in the newspaper, all that means is that the bank has a lender in the form of the Federal Reserve, right? We've already discussed that the Federal Reserve was created to be the lender of last resort. So if a particular bank is in some amount of distress for a short duration, it can go to the Federal Reserve, and the Federal Reserve has a facility where it makes short-term loans to these banks so that they can cover these liquidity concerns in the short run, and then they repay the money back to the Federal Reserve once that liquidity problem has been met. Right? So banks end up borrowing in a variety of different ways. from each other in the federal funds market. That's the where banks, that's the interbank market. So where banks borrow and lend to each other overnight, short term deposits, small amounts of money, sometimes larger amounts of money. And the reason why this market even exists is because of what is known as the reserve requirement. Okay, so in order to make sure that banks are not don't become too illiquid, the Federal Reserve passes regulations which requires that banks hold a portion of its cash in the form of reserves. Okay, so suppose the bank takes in deposits of $100 million, right? Now, people who have deposited money in the bank, they do transactions on a day-to-day basis, right? You go to buy a gallon of milk, you go to the shop, purchase something with your debit card. All of those purchases need to be serviced, right? Because when you swipe your card, you're essentially authorizing the merchant to take that amount of money out of your checking account. Now, the bank needs to maintain enough cash on hand in order to service all of these transactions, right? So the Federal Reserve mandates, right now the Federal Reserve requirement is about 10%. So 10% of all the assets that the bank holds should be in the form of cash. So of that $100 million of deposits that the bank has, at least $10 million of it has to stay at the bank at any given point in time, right? So, but suppose you are having a high volume day, there's some big transactions all happening on the same day, and you fall below it. Instead of having $10 million on hand, you have only $9 million on hand. But so you fall up for, you don't meet the reserve requirement, and it's the end of business that day, and you can't you need to meet the reserve requirement when you close down for the day, right? So what do? You go to your neighboring bank and say, hey, can you lend me $1 million so that I can put it in my bank's vault, and I'll meet my reserve requirement. And in the morning, as soon as I open for business again tomorrow morning, I'll return the $1 million and a little bit more, right? Maybe $1,000 more, and I'll be your fee for facilitating this transaction. And that's basically what the federal funds market operates like. It's an interbank market where banks are borrowing and lending to each other in order to make sure that they all stay compliant with the reserve requirements that the Federal Reserve imposes. Okay. So that's one big part of the borrowing that the bank does, right? So if you look at the bank's balance sheet, so from banks in the US, it's about 0.5% of the bank's balance sheet is in these things, right? Okay. With repurchase agreements is a modern version of the same thing. Okay, what a repurchase agreement is that instead of lending and borrowing money from each other in this interbank market, right? What banks do is that they lend and borrow securities, lend and buy securities from each other for short durations. Okay, so here is the genesis of the idea for a repo market, right? So banks realize that they have a lot of liquid securities, right? They hold a lot of their assets in the form of US government treasuries. So a repurchase agreement essentially says, okay, I will sell. So suppose I need $1 million to meet my reserve requirement. I'll sell $1 million of my uh, US treasury assets to my neighbor bank, right? Suppose it's Bank of America and JP Morgan, and Bank of America needs $1 million in order to meet its reserve requirements. It says, okay, JP Morgan, I'll give you $1 million of US securities today, for $1 million in cash. And so I have my, um, uh, so I can meet my reserve requirement. And next morning, as soon as I open for business, I'll buy back the securities from you at a pre-agreed rate, right? So instead of $1 million, I'll buy it back from you for $1,000,000. So I get back my securities, and you get $1,000 extra and your $1,000,000 back, and we are fine. This is a safer way to do this transaction because what we have here is collateral, because the entire transaction is collateralized with physical securities, because securities are physically getting transferred from one bank's balance sheet to the other. Now, if Bank of America, which borrowed the money the previous day, can't make that payment the next day, JP Morgan is not in trouble because JP Morgan owns $1 million of government securities, and that's already on its balance sheets, and so it can sell it and get its money back. Okay, so a repo agreement is basically what was happening in the federal funds market, but now with the additional protection of collateral, right, of physical securities underlying the entire transaction. All right. Um, Here's a quick snapshot of the evolution of the checking account. And what we have here is a time series that goes back to about 1973 and ends in about 2016. And what we see here is obviously the rise and fall of the checking account, right? So checking accounts are quite popular, right? About 30% of all assets are were held in the form of checkable deposits. So people really like to have liquid cash, a lot of liquid cash on hand all the time. And so about 30% of the deposits were in the form of checkable deposits. But as you see over time, that has fallen dramatically, right? Over time, by the time we get to 2016, it is about only about 14% of all deposits, or if we saw a number, it was about 12.5% of assets of the bank's liabilities are in the form of checkable deposits. And there's been a bunch of research into this as to why checking accounts have fallen out of favor as the preferred place to park your money. And the primary reason that we've come up with is what we call wealth effects. Okay, and here we see exactly what we mean by that, right? What we see is that as households and firms get wealthier over time, they don't want, they have more wealth, and then they keep a smaller and smaller proportion of their wealth in the form of checkable deposits. They don't need access to a large, right? If when you have only $2,000 in your in your account, you might want to keep all $2,000 in the checkings account, because you might need all of that money all of the time because you're cash constrained, your wealth constrained. But suppose you are worth $2 million, there's no reason for you to keep $2 million, all of that in the checkings account on any given day or any given week or any given month. You're not doing $2 million worth of transactions anyway. So you keep a small proportion, maybe 10 grand in the checkings account, and the rest gets parked inside the savings account. And the reason why you want to park the rest inside the savings account is because the savings account will pay out an interest. And that's what we see, right? So uh, if you see the biggest bar here, most of this money, like the liquid money, is in the form of savings account and small time deposits. Some is held in the form of currency. About this is in billions of dollars. About $1 trillion is held in the form of currency. Then some in larger time deposits, checkable deposits about 2 trillion, money market mutual fund shares about 3 trillion, and then savings account and small time deposits we have over about $9.5 trillion in that. And this entire evolution, this decline of the checking account and the rise of the savings account, is mostly attributed to the fact that the economy as a whole has done well, and people have gotten wealthier and wealthier, and they've resorted less and less to the use of a checking account. Okay. On the other side of the story is bank assets. So that's basically the discussion around all the different liabilities that a commercial bank has. We talked about deposits in the form of checkable deposits, what are non-transaction deposits, what are all these borrowing liabilities that the bank has, and now we'll turn our attention to the assets that the bank has. What are the different kinds of assets that the bank owns? Okay, now bank assets are assets in the sense that they are financial claims that the bank has on somebody else, and these assets are purchased or financed from a variety of ways. Most of it is financed with money received from depositors. So you use depositors' money in order to make loans, and that's the primary way that the commercial bank operates. But that's not the only way, right? You can borrow money from other institutions in order to facilitate these transactions to acquire assets. You can acquire initially from shareholders. So when the bank itself is getting set up, it has no money, it has no deposit. So the owners of the bank pool in their money together and get the bank started. So that is what is used to initially build out the loan book of the bank. When you don't have any deposits just yet, or you have very small deposits and you're still waiting to build up the deposit side of the account, you rely mostly on bank capital to get the business off the ground, to get the bank off the ground. And any profits that the bank generates in its day-to-day operations, which are retained at the firm, can be used to further expand its asset base to purchase more assets. Okay. Uh, so the first key asset is obviously reserves, right, and vault cash, right? Anything in order of liquidity. So we'll start with anything which is held in the form of cash. Uh, so vault cash, is as the name suggests, this is literally cash which is it's sitting in the bank vaults in the form of currency, and any bank deposits that the bank has with the Federal Reserve, right? So the Federal Reserve is a bank to the banks. So a bank like JP Morgan will have an account open with the Federal Reserve as well, so it can keep some of its money at the Federal Reserve to meet its reserve requirements and other obligations and so on and so forth, right? Vault cash is basically cash which is on hand, which is sitting in the vault, but also any cash which is sitting in the ATM machines of the bank operates, right? There's liquid cash. So that's one bank asset. And when we talk about reserves, we've already discussed this, that the Federal Reserve mandates that the bank holds a portion of its assets in the form of reserves, right? So based on the size of the demand deposits and the negotiable order of deposits, the checking accounts, depending on the size of uh, those accounts that the bank has, the Federal Reserve will mandate that it hold a particular percentage of those assets in the form of just reserves. You can't uh, take all 100 million. So if you have $100 million in checking account deposits, you can't take all $100 million and send it out of the door in the form of loans. You have to hold a portion of it in the bank in the form of liquid vault cash, or in the ATMs or whatever, wherever you can get that cash immediately, easily, and it's accessible. Okay. Above and beyond the required reserves, some banks might choose to keep additional cash on hand. This is what we call excess reserves. This is not federally mandated. You don't, this is not, your regulator is not telling you that you need to hold this amount of money in the form of reserves at the bank. This is just out of an abundance of caution that you might want to hold excess reserves at the bank, right? And the reason why some banks might want to use keep excess reserves on hand is particularly true in times of crisis, right? When you're having a massive liquidity crisis, you don't want to run around pillar to post trying to find cash, right? So you might want to hold a little bit more than what the reserve requirement is in order to weather any strains in liquidity that come in, right? The other advantage of it, the downside, not the advantage, the downside of holding excess reserves is that you're holding excess reserves. These are reserves which are in the form of cash, so they're not earning any return. They're just sitting idle on the bank's balance sheet. And you might want to not hold too much excess reserves in times of crisis, or if you are projecting that there's some crisis coming around, you might want to hold on to as much cash as possible and build up some excess reserves. And once the crisis passes, you wind down all those excess reserves and actually turn them into productive assets, right? You start making loans with them and so. The second kind of bank assets that we want to talk about is securities, right? When we talk about securities, these are just financial claims which are tradable. These are marketable securities, right? Liquid assets that banks trade in financial markets. Okay? So banks are allowed to hold gold-plated U.S. Treasury and government agencies and corporate bonds, right? So in the form of securities, banks are limited to those things. You can buy bonds from US government, so you can essentially lend money to the US government, and that's fine because that's a very safe asset class to be in. You can also go to other government agencies like state and municipal level bonds. You can buy those, and you can also buy corporate bonds of high credit, right? You can't buy junk bonds really. You can buy like AAA rated corporate bonds, right? You might can buy bonds in, I don't know, IBM or Apple or something. Okay? So bank holdings which are held in the form of US treasuries are also called secondary reserves, right? They're called secondary reserves because US treasuries are very, very, very liquid, right? Because the market is very thick, the market, and if no one else will buy US treasuries, the treasury itself or the Federal Reserve will buy those securities from you. So you don't have to worry about it, and you can very quickly turn these treasuries into cash if you need them. So another measure of liquidities that regulators sometimes use is to look at the reserves that the bank holds, but it also looks at the secondary reserves. It also looks at how much of the bank's assets are in the form of US treasuries, especially short-term treasuries, because they can be quickly turned into cash. Now, in the US, and this is the case in most advanced economies, commercial banks, which are holding a commercial bank charter, cannot hold any of their assets in the form of corporate securities or corporate bonds, right? Some corporate bonds are exempt from this. A high grade corporate bond, so there's a list of, like, we talked about credit agencies and the ratings that they give. You can buy AAA rated corporate bonds, but not, you can't just go into a corporate bond market and start buying corporate bonds using the depositors' money, right? Because as the commercial bank charter, when you incorporate yourself as a commercial bank charter, you stated um, uh, stated function is not to be an investment bank. You're not taking money from people and trying to invest it in as productive activities as possible. You're taking money from depositors and you're going to make loans with them, right? You don't want to, like, collect a lot of deposits and just go play the stock market with them. That defeats the purpose of a commercial bank, and that's one reason why commercial banks are barred from holding any kind of stock. You're not allowed to hold any stock, but most corporate bonds are also not allowed, right? Some corporate bonds are still okay, but most of them are not. The third big asset that the bank has is what we call loans, right? This is what the bread and butter of a commercial bank are, right? And it's the most illiquid portion of the bank's asset portfolio, right? They're illiquid. They're not only illiquid, obviously, when you make a mortgage loan, right? So somebody comes into your bank, they want to take out a mortgage. It's a 30-year mortgage, and they're going to make payments every month for 30 years. It's not the greatest security, the most liquid security in the world, right? It's still liquid. You can take this loan and sell it on to other banks and so on and so forth. It's still liquid, but it's less liquid than a security which can be traded directly on the stock exchange, right? Or in some kind of alternative financial market. So there's three major categories of loans that banks make out. Obviously, loans to businesses. These are what we call commercial and industrial loans. Consumer loans. These are made to primarily to households to finance household consumption needs, to buy auto loans and home loans and auto loans and I know personal loans and any other kind of loan that you can think of, credit card loans. And real estate loans, this is about residential and commercial mortgages. Real estate loans are listed separately because they're collateralized by the underlying asset, which is the mortgage against which that loan has been given. Okay. So if you look at the evolution of the bank's loan book, of typical commercial bank's loan book, here you can see the mix in 1973, right? About 20% of the, about close to 28% of the loans were in the form of consumer loans, about 32% in the form of, in the form of real estate loans, and about 40% in the form of commercial and industrial loans. C&I here stands for commercial and industrial. But over time, you can see that, okay, consumer loans have fallen a little bit out of favor, but so have commercial and industrial loans, right? As a proportion of the bank's assets, they've declined quite a bit. But at the same time, you see a large increase in the real estate loan book, right? Which went from over 32% in 1973 to about 60%. And at the height of the financial crisis, over 60% of the bank's loans were in the form of real estate loans, in the form of mortgages, both commercial and residential. And that kind of gives you an indication of why the crisis was as severe as it was. If 60% of your loan book, and the loan book is the largest portion of your assets for a commercial bank, is in the real estate and market, a small change, a small adverse change in that market is going to affect you in a profound way, right? And that's this evolution right here gives you straight away an indication of why a small crisis in the mortgage market transforms itself into a large financial crisis which engulfs entire banks and the entire banking industry as a whole. Okay. Uh, Other assets, obviously, the bank owns other physical assets, right? It owns its buildings, it owns equipment, it owns computers, furniture, whatever have you, all of that. Uh, there's physical assets, and there's also collateral, right? So this is collateral which has been given over to the bank, right? So suppose you make out a mortgage and the person stops making the mortgage payments, then you foreclose on that house, and now you own the house. The bank owns the house, owns the collateral, and so some portion of the bank's assets are in the form of these collateral which is collected. Okay? All right. The last line item that we want to talk about is bank capital, right? Bank capital, which is also called shareholders' equity or the bank's net worth, is the difference, as we said, between the value of the assets that the bank owns minus the value of the liabilities that the bank owes, right? So bank's capital basically represents the value, right? The marketable value of the funds that were given over by the bank shareholders through either the purchases of the bank or when the bank was incorporated originally and through accumulated retained earnings, right? So the bank does its operations and then it generates profits, and it can take some of those profits and reinvest it, and but all of those profits are technically should belong to the bank's shareholders, so that's also included in the bank capital, right? So about 14.5% of bank assets of the as a whole in the US is in the form of bank capital. And as the value of the bank's assets or liabilities change, the bank capital rises or falls, right? If the bank's assets go up relative to the bank's liabilities, then obviously bank capital increases, and that's a great thing. But if bank's liabilities go up relative to bank's assets, then the bank capital is shareholders' equity is coming down, right? Okay. So here's a quick uh, way for you to test whether you understand how to construct a balance sheet. So, what I would like for you to do here is to pause the video, take a look at all these items, and then create a balance sheet out of it. So, look at each item, right? You put the assets on one side, the liabilities on the one side. Take each item and decide whether it belongs in the assets portion of the balance sheet or the liabilities portion of the balance sheet. So, take a few minutes to just run through that exercise before unpausing the video, and I'll show you what it looks like. So each of these you can straight away begin to slot, right? So cash should be an asset, right? It's an asset to the bank. Non-interest bearing deposits, a deposit is a liability to the bank. Okay, so cash I put on the asset side, non-interest bearing deposits I put on the liability side. Deposits with the Federal Reserve, this is a claim on the Federal Reserve that the bank has. What is it? It is an asset, so it goes here on the asset side. Commercial loans are assets to the bank, so commercial loans go on the asset side of the bank. Long-term bonds, which are issued by the bank, so there's long-term borrowing that the bank is doing, so there's a liability on the bank. So long-term bonds goes on the liability side. Real estate loans, any kind of loan is an asset to the bank, so that goes on the asset side. Commercial paper and other short-term borrowing, again, this is borrowing that the bank is doing, so that goes on the liability side for the bank. Consumer loans are assets to the bank, securities are assets to the bank, interest bearing deposits are liabilities on the bank, buildings and equipment are assets to the bank, other assets are assets to the bank, and other liabilities are liabilities to the bank. So you can list all the assets, all the liabilities. So once you arrive at the total assets, and then once you arrive at the total liabilities, the difference between these two numbers, 2,223 and 1,992, this difference between two numbers is what is bank capital. Okay. And then you need to make sure that the books balance, that the total liabilities plus bank capital should be equal to the total assets of the bank. Okay. The other thing that you might want to know about the bank is it's what we call the bank capital as a percentage of its assets, the bank's equity ratio in a certain sense. We want to know, given the size of the assets that the bank owns, what portion of that assets have been purchased using shareholders' capital, and what portion of it has been purchased using deposits, right? So if the total assets of the bank are 2.23 billion, let's say, and bank capital is $231 billion, so there's 2.2 trillion. and $231 billion is bank capital. Bank capital as a percentage of assets is 231 billion over 2.2 trillion, or 0.104, or 10.4%. So for all the assets that the bank owns, which is about $2 trillion worth, about $230 billion of those assets have been bought using shareholders' equity and or shareholders' capital, and the other 89.6% of the assets are being financed through the deposits and other borrowings that the bank is doing. Okay. So the higher the ratio here is, the more skin in the game the bank's shareholders have in the functioning of the bank, and the lower the ratio here is, the less skin in the game, and the depositors are more exposed to the bank's vagaries, whatever fluctuations in the fortunes of its bank. Okay. All right. I hope that makes sense so far. And then we'll now turn to describing the basic operations of a commercial bank. All right, so then we'll talk about the basic operations of a commercial bank, and we'll see what a T account looks like and how a bank generates loans. Okay, so here's a basic, very basic version of how a bank operates, right? So suppose someone shows up at Wells Fargo with $100 in their hand and they want to make a deposit, right? So as soon as the $100 comes into the bank, you credit both the assets and the liability side. So on the asset side, vault cash goes up by $100, and on the liability side, checkable deposits go up by $100, right? Now, Wells Fargo doesn't have to hold all of this $100 as at the bank. They can just hold their reserve requirements. So suppose the reserve requirement is 10% outstanding of the checkable deposits. So the required reserves are $10. So Wells Fargo is obligated to keep at least $10 in the bank, and the rest it can do whatever it wants, right? So excess reserves of $90, liabilities is still $100 of checkable deposits. Now, what Wells Fargo chooses to do with this is that, okay, so $90, it just doesn't want to sit idle at the bank. It wants to buy some assets with it and earn some money, earn some interest on it. So Wells Fargo goes out and buys $30 worth of securities, and because it's a commercial bank, it makes out a bunch of loans. So $60 worth of loans, and this is how uh, uh, the commercial bank operates, right? So the commercial bank takes in deposits, holds the required reserves on its balance sheet. The rest it takes and makes uses its excess reserves to buy securities and make loans, right? So how is a bank profitable, right? How is a commercial bank profitable? And the primary measure of profitability for a commercial bank is what we call as net interest margin. So net interest margin is the difference between what the bank receives on its securities on loans, what it earns on its assets, and what it has to pay on deposits and debt. What the cost of servicing its liabilities are, right? So and you divide it by the size of the total asset that the bank owns, so the total value of its earning assets. So the net interest margin. So if you think about it, the commercial bank's business model is fairly straightforward. It takes in deposits, and suppose you have to pay 2% interest rate on your deposits. Now it takes those deposits, holds a fraction of it as reserves at the bank. The rest of the money can go out in the form of loans and securities. So if you're able to lend out the money at 5%, let's say, the net interest margin there is 3%, right? Because 5% is what you're earning on your assets, 2% is what it costs to service your liabilities. The difference is the net interest margin, and we divide by the bank assets because different banks have different asset bases. So you want to make sure that the comparison, the percentage is comparable between banks because it's as a fraction of its total earning assets. Okay, so the bank's return on assets, it's another measure with which we measure bank profitability, is its after-tax profit over the size of the bank's assets, right? Over the asset base, what is the after-tax profits you are able to generate? Other measures that we might want to consider is from the shareholder's point of view, right? The shareholder is interested on the return that they earn on their equity contribution. So the return on equity is the after-tax profit. So what the after-tax profit that the bank generates as a fraction of its bank capital. So on this amount of invested bank capital, what is the after-tax profit? So that ratio tells us return on equity. Okay. So now return on equity is related to return on assets by a very simple formula, where return on equity is return on assets times bank assets over bank capital. Okay, so this bank assets times bank capital is also what we call leverage. Okay, so banks, managers of banks and other financial firms, they have incentive to hold a high ratio of assets to capital, right? Why do they have a incentive to have a high ratio of assets to bank capital? If this ratio is very high, a small change on return on assets gets magnified by whatever this ratio is. So suppose bank assets to bank capital, if this ratio is 10, so if the return on assets is 2%, then 2% times 10 is 20%. So the return on shareholder equity is 20%. But if this ratio is 20, then the same return on assets of 2% is now magnified by 20-fold. So the return on equity is 40%. So managers of the bank and the bank's shareholders, they want this bank assets to bank capital ratio to be very high. Okay. But what does it mean for bank assets to bank capital ratio to be very high? It means that as a fraction of the total assets that the bank owns, the contribution of bank capital is very small, right? If this ratio has to be very large, the numerator has to be big and the denominator has to be relatively small to the numerator, and that makes this ratio quite large, right? So in a fraction, the numerator is large and the denominator is small, then the entire fraction blows up because you're dividing by a smaller number. So the ratio of assets to capital is one measure of what we call bank leverage, right? The inverse of which, capital to assets. So if you take the inverse ratio of bank capital to bank assets, that's what is known as the bank's leverage ratio. Okay. So leverage is a measure of how much debt is being used in order to purchase these assets and to finance all the uh, uh, operations of the bank. The higher the leverage ratio, the higher the reliance on debt to fund the firm's the bank's operations, and the lower the reliance on equity. The higher the reliance on debt, it means that if there are small changes to the return on assets, it can magnify into large returns on equity if the leverage ratio is really high. Okay, so a high ratio of assets to capital, which is what we call high leverage, is a two-edged sword. If the going is good, if the return on assets goes up by 2% and the leverage ratio is 10, then the return on equity is 20%. But if the return on assets is negative 2% and the leverage ratio is still 10, the return on equity is negative 20%. So leverage not only magnifies the upside, so if you carry a lot of leverage on the bank's balance sheet, it not only uh, magnifies the upside, it also magnifies the downside. So leverage can magnify relatively small ROAs into large ROEs, but it can do the same for losses, right? So that's the reason why you have to be very careful about how much leverage you take on. All the incentives for the banks are such that they operate with very high leverage ratios, but as we can tell, both losses and gains are magnified quite significantly. Okay? And the primary cause of concern here is the moral hazard problem, right? Now, managers, if you think about it, are compensated. So as a shareholder of the bank, I want to hire managers who will maximize my return on equity, right? So I want to hire people who will operate this firm in such a way that the return on equity is maximized. Now, there's two ways with which I can boost the return on equity. I can raise the return on assets, which is really difficult to do, really cumbersome process to do, or I can dial up the leverage. And the incentives are all to dial up the leverage, because all you're doing is that you're just borrowing more money or taking more deposits and just keep buying more and more assets, and that dials up the leverage. And without having to alter the return on assets too much, you can deliver high returns on equity, right? So if managers are then, if the incentive structure for managers is based on, if they're compensated based on how high the return on equity or the ROE is, they might take on more risk than they should. Okay. So that's the moral hazard problem, right? The incentives are lined up for people to do bad things, and the federal deposit insurance makes it even makes this problem even worse, because the federal deposit insurance says that no matter what the bank does, however egregiously poorly it's run, however outlandish the risk it takes, up to $250,000 of depositors' money is insured, which means that depositors are not worried. So depositors are not closely monitoring what the bank is up to, and banks have all the incentives to dial up leverage as much as possible, and that introduces this moral hazard problem. Okay. Now, in order to combat this, the government imposes what are known as capital requirements. This is an indirect way of managing how high the leverage ratio can get, right? If you say that bank capital needs to always be a particular uh, proportion of the bank assets, that bank capital can never fall below a particular ratio, right? This bank asset capital to bank assets ratio, if it never can't fall below a particular ratio, that reduces how much leverage that puts a ceiling on how much leverage you can carry on the balance sheet, and that might mitigate some of this problem. Okay, so that's basically how a basic introduction into how a commercial bank operates. Now, banking is a risky business, and we will turn to this question of how do banks manage risk, right? So there is the first big risk that banks face is what we call liquidity risk. Liquidity risk arises from just the fractional reserve banking system that we implement in most economies. What does it mean? Now, when depositors deposit their money, the bank is not holding all of their money in the bank at any given point in time. It's holding only a fraction, the reserve requirement at the bank. The rest is sent out to buy either securities or make loans or what have you. Now, if the deposits all make a run on the bank and want their money all at the same time or more than whatever is held in reserve at that time, the bank faces a liquidity problem. Right? There's a liquidity crisis. If I took in $100 worth of deposits and I hold $10 in the bank and the other $90 are out in the form of securities or loans, now what happens when people come in and they want $20? I only have $10 in cash, so I can give that $10, but I need to come up with the other $10 somehow. What can I do? I can start selling securities at a loss, right? These assets that I purchase, I might have to sell them at a loss just to get money, or I might have to call in some loans early to get some money, and it all creates a whole bunch of problems, right? So that's what we mean by liquidity risk, right? There's this problem with how do we manage liquidity risk, and we manage liquidity risk as a bank using two primary strategies. You can use asset management or liquidity management. With the asset management, you're managing the assets of the firm in such a way that you're buying and selling securities, and you're making different duration loans in such a way that you're able to weather these kinds of changes, right? So you're lending funds in the federal funds market, usually one day at a time. You're doing all these day-to-day operations. You're managing the assets of the firm in such a way that you don't have like a liquidity problem. Uh, Reverse repos are quite popular. Reverse repos is exactly the opposite of the repo. Instead of selling a security and then buying with the promise of buying it back later, you buy a security and sell it in the next day, right? So this is so the counterparty in the repo agreement is involved in a reverse repo, right? Liquidity management usually involves what is the best mix of borrowings, right? Using repo agreements and discount loans in order to manage day-to-day ongoing liquidity concerns for the bank. Okay. The second big risk that banks are faced with is credit risk, right? Defaulting on loans, right? That you lend out money in the hope that people return that money, but there is always a non-zero probability that people might default on their loans. And banks usually mitigate this risk by diversifying their loan portfolio as much as possible, right? If you're only exposed to a couple of big, right, you lend money to only a couple of big players, and if both of them go bust in the same event, you're wiped out with them. So instead, banks rely on, like, they don't really commit a lot of their assets to a single loan. They usually try to spread out as much as possible and diversify their loan book as much as possible, and that basically reduces the credit risk dramatically, right? We've already seen gains to diversification in the context of a stock market portfolio. This is similar. You're managing an asset base as a bank, and there are gains to be had from diversification, from making your loan book as widely diversified as possible. Okay. The other way that banks manage risk is to what we call credit risk analysis, right? So with credit risk analysis, the basic idea is fairly straightforward, right? You use a credit scoring mechanism, what we know now as the FICO score, in order to rate borrowers on their credit worthiness, right? And historically, the highest quality borrowers, so based on your past history of payment and how well you use debt, and how how responsible you are and how high your income is and so on and so forth, you can essentially classify your borrowers into different classes, right? People of the highest quality who have a lot of income, a lot of wealth, their probability of default is going to be low, versus people who don't have as much income or wealth and they rely on a lot of credit card debt to get by. They are much more risky. And the higher historically, the highest quality borrowers paid what was called the prime rate, but these days that prime rate is not a fixed rate anymore. It's like an adjustable rate based on what is happening to market conditions. The prime rate essentially also is changed, right? So if the Federal Reserve cuts interest rates, then the prime rate also falls in line with it. And if the Federal Reserve increases interest rates, then the prime rate also goes up in line with it. Okay. So in a real world example, this is where the FICO scoring mechanism comes from. This is a credit risk analysis method where you're using a credit scoring mechanism in order to manage some of this default risk inherent in it. So FICO is an abbreviation for the Fair Isaac Corporation, right? It was founded in 1956, and they came up with the first model, the mathematical model, in order to basically score people on their credit worthiness. So typically, on a scale of 850, you need a score of about 740 or more in order to qualify for the best interest rate on a car loan or mortgage loan. So you need to have a high FICO score. And the way this FICO score is calculated is fairly straightforward. Right? 35% of the score is dependent on your payment history, right? So if you make on-time payments consistently every month, even if you don't pay off your credit card bill in full, even if you make the minimum payment consistently every single month, that's a um, considered a good sign. So 35% of your score is based on-time payment history. Uh, the 30% is how much credit you're using, right? Amount of credit card debt relative to the available credit limits. So if you're maxing out your credit cards every single month, that gives you an indication to the bank that you use a lot of credit, which means your income might not be as high to compensate for your consumption, and that might be a problem. How long you've been using credit, like length of history, 15%. The longer the history, the more information they have. So that accounts for 15% of the score. How many different types of credit you manage is about 10% of it. Um, so uh, if you have if you have the capacity to manage different kinds of credit instruments, that gives them banks more confidence. And how many credit accounts you have open, right? The number of accounts. This one is a little bit counterintuitive. The more accounts which are open for longer, the better the score is, generally speaking, because that indicates to a bank that you're able to manage a lot of different cards and make on-time payments on all of them and manage your credit. But at the same time, you have like a nice demand for credit as well. So they like to see that as well. So that basically, if you take these 5 different criteria into mind, that these are 5 things, and these are the relative weights assigned to each of these categories into what goes into calculating the credit score. Yeah. So another way that banks manage their credit risk is through the use of collateral, right? So collateral is some assets that you own that you pledge to the bank. In case of default on the loan, the bank can basically take over this collateral, liquidate it, and get their money back, right? So a typical example is the mortgage. So as long when you borrow money to buy a house, the bank basically owns the house till you make the mortgage, finish paying off your mortgage, right? Once you're done paying off your mortgage, then the house becomes your own. And if you default at any point during the duration of the mortgage, you basically lose the house, and the bank takes over the house and then puts it on the market and sells it and recovers its money, right? And another mechanism that's often used by these banks to manage this is what's known as a compensating balance. This is usually done when the loan size is very, very large, right? If you take the loan for 100, I don't know, let's say $100 million from a bank, the credit risk is really high for them to bear, right? So in order to make sure that you don't default, you're required to open a checkings account with the same bank and maintain what is they known as call a compensating balance, right? You maintain a minimum balance in the checking account. So in case something happens to your company and if the loan looks shaky, first of all, that whatever money is in the compensating balance account can be used to stanch some of the short-term losses that the bank can face. while they pursue you and collect that money back. Okay. Um, Another mechanism through which you manage credit risk is credit rationing. This is basically establishing limits on borrowing as to how much you can lend, right? So based on no credit card is going to give you a carte blanche unless you're really wealthy to spend how much ever money you want. If you have a credit card, you know that the credit card comes with a credit limit, and the credit limit is basically determined by how much the bank thinks you are capable of managing the credit responsibly, right? So if you have a short credit history, a bad credit score, and you max out your credit cards a lot, when you open a new credit card account, you get a small credit line, right? Because the bank doesn't want to carry all of that risk on its books. So what it does is that it sets up this credit rationing, and prime borrowers obviously will have higher credit limits on their cards, right? So if a problem here in this situation is that with credit rationing, it's a solution to this adverse selection problem, right? So if the bank cannot reasonably distinguish between a low quality borrower and high quality borrower, what happens? The bank basically ends up charging everyone a higher interest rate because it can't tell whether you're high quality or low quality, and then and you have a problem. What is the problem? If you raise the interest rate too high, the people who are high quality will go elsewhere, right? They don't want to use credit where the interest rates on that are very high. So the only people who will be left still wanting credit at these really high interest rates are people who are high risk, and that's exactly the problem you're trying to avoid. So all the people who are left over are basically high risk people, and you have an adverse selection. So credit rationing is one way to mitigate that by limiting how much credit you give to different borrowers and slowly raising the limits over time as they establish a history. As you gain more and more confidence in the ability to repay their money, you start to raise their credit limits and offer them more credit. Okay. Right. So another way that banks keep track of credit risk is by imposing restrictive covenants into their loan contracts, right? So it bars people who borrow money and who have loan contracts with the commercial bank from engaging in certain activities, right? So again, all of this comes down to this notion of asymmetric information, right? So in game theory, there's this idea that uh, one party knows more than the other. You have private information that the other party doesn't know, and that private information is actually important for the other party to judge credit risk accurately. So with these restrictive loan covenants, we basically try to screen for particular characteristics that might uh, be harmful to the execution of the loan contract, and then you just make those provisions explicit within the contract itself, right? So the last thing that we want to discuss here with the kind of risk that commercial banks have to manage is what we call the interest rate risk, right? So what we know is that the present value of any asset is just the discounted future cash flows of that asset, right? So if the underlying interest rate changes, the interest rate at which you're applying the discount rate is going to change, then that has an effect on what the present value of the assets and the liabilities are, and that poses a risk to the bank's balance sheet, right? So if there is a rise in the interest rate, then the present value of assets of whatever it is that you're measuring, whether it's assets or liabilities, is going to fall. And if there's a fall in the interest rate, then the present value goes up, right? For instance, if you take a look at this balance sheet for a made up national bank, this bank has fixed rate assets of about $350 million and adjustable rate loans of $150 million. Right? So the total assets are 500 million. And on the liability side, it has fixed rate liabilities of 250 million, but the variable rate liabilities of 210 million and bank capital of 40 million. So, the balance sheet balance. But the crucial thing to recognize here is that, okay, fixed rate assets, they pay out a specified interest rate, so they don't have any interest rate risk attached to them. The same thing with fixed rate liabilities, that there is a constant cost of borrowing which is pre-agreed to, so that rate doesn't change. Okay. The problem comes down to when you consider variable rate assets and variable rate liabilities, where the interest rate that is charged on these assets uh, or the interest rate that is charged on these liabilities is going to change. And if that changes, the present value of those assets changes, and that poses a risk. Okay. So one way in order to measure what this risk looks like is to do what we call gap analysis. Right? With gap analysis, all we are trying to look at is the dollar value. The crucial thing is that with gap analysis, we consider the dollar value of the difference between the bank's variable rate assets and its variable rate liabilities. Okay, so once you establish what the gap is, and if the interest rate in the market changes, then you again you redo the math, figure out what the present value of the assets is and the present value of the liabilities is at the new interest rate, and then look at that difference, right? So most banks obviously have negative gaps, right? So what does it mean for it to have negative gaps? Most banks' balance sheets look something like this, where your assets, the variable rate assets, the dollar value of the variable rate assets is going to be lower than the dollar value of the variable rate liabilities, right? And that's because liabilities, more or less, generally speaking, have are more likely to have variable rates, right? Because your liabilities are your deposits, and the rate on those deposits changes based on market conditions. So if the Federal Reserve cuts interest rates, you might have to cut interest rates in line with it. And if the Fed raises interest rates, you might have to raise rates in line with it. You have to take into account inflation. You have to take into account competitive pressures. If you have other banks who enter the market and are going to offer higher interest rates to attract customers, you might have to match those. So your liabilities end up having, more often than not, the dollar value of the variable rate liabilities is going to be higher than the dollar value of the variable rate assets, which means that there is generally going to be a negative gap. And straight away you can see, if you have a negative gap, uh, it might pose a problem, right? So most banks generally end up having a negative gap. So what happens if there's an increase in the market interest rate, right? So if there's an increase in the market interest rate, the present value of the liabilities, right? The present value of the liabilities, because it's higher, is going to become larger relative to the present value of the assets of the bank owns, which makes the gap even more exacerbated, and bank profits will fall in line with it, right? And if there's a decrease in the market interest rate, again, it's the same story. The present value of liabilities will fall a lot more than the present value of the assets, because the numerator on the asset side is always smaller. So you're going to have the gap reduce, and that increases bank profits, right? So one common measure that is reported when these financial statements are published is a rudimentary gap analysis to understand what the overall financial position of the firm is. The other analysis which usually accompanies these financial statements is what we call duration analysis, right? Duration analysis is about the time span on which these assets and liabilities are going to pay out, right? So when we do the present value calculations, we concern ourselves primarily with only three things, right? We need to know what the size of the cash flows are. We need to know what the appropriate discount rate to apply to these cash flows. And then we need to know the timing of the cash flow, right? So based on when the timing of the cash flow, the present value is going to be more sensitive, if more or less sensitive based on when the cash flow arrives, right? So the problem obviously is that the bank's assets, right? If you think about a loan, like a mortgage, for instance, is a very it'll generate cash flows for about 30 years. On a 30-year mortgage, you're going to get monthly payments on that mortgage for 30 years. So it has a very long duration. And for a commercial bank, which relies primarily on loans to get its business going, you're going to have this problem where your assets are usually going to be longer duration than your liabilities. Your liabilities are deposits, and deposits don't want to lock in their money for long duration. So they're going to come due much more frequently, and the uh, maturity on the liabilities are going to mature at a faster rate than your assets will pay out. And then that generates what we call a positive duration gap, right? Because there's a mismatch between the maturity period of your assets, which generally tends to be longer, versus the maturity period on your liabilities, which tend to be much shorter. Okay. So if there's an increase or decrease in the market risk, that affects what happens to the duration gap as well. right? Most banks have a positive duration gap. Again, that the reason for that is because assets have longer maturities than liabilities, and if a market interest rate changes, it decreases bank capital, right? Because again, assets are discounted much more relative to liabilities, and you see a decrease in bank capital. And again, if there's a decrease in the market interest rate, it's the opposite effect, right? All right. So the big thing I really want you to take away from all of this is that when you look at a bank's balance sheet, it's just not about the level of bank capital or the nature of the liabilities and all of that. There is also these other attendant nuances, right? So this gap and duration analysis are innovations of the last 30, 40 years, because generally speaking, when we used to look at the balance sheet, we just looked at the assets, we looked at the liabilities, we looked at the quality of the assets, quality of the liabilities, without really considering the fact that there's this big mismatch that happens when you have variable rate assets and variable rate liabilities which are thrown into the mix, right? And then you need to employ a little bit a more fine-toothed analysis to get to the true situation with them. All right. The last thing, this is what we'll conclude with this entire session with. We'll briefly go over the history of US commercial banking, and then we'll conclude with what happened during the financial crisis to commercial banks. Again, the extended discussion around the financial crisis and its aftermath is reserved for the end of the course. When we'll talk about the crisis of 1907, the Great Depression, and the financial crisis of 2007, 2009, we'll work through case studies of all three of them. But for now, we'll just tie in what we've learned about commercial banking to the financial crisis as a starting point to get the discussion rolling for the future sessions. Okay. So the early history of US banking basically begins with this notion of a charter, right? So when we see banks, some banks carry what is known as a federal charter, and some banks carry what's known as a state charter, right? And the basic idea is straightforward. A charter is just a license, right? If your bank only has a state charter, it's licensed to operate with only within the geographic confines of that state. It can only take deposits within that state. It can only buy securities and other make loans within that state, and it can't cross geographic boundaries. It can't operate in any other states. And if a bank is federally chartered, obviously it can engage in interstate commerce, which is to say it can have multiple banks and multiple branches in different states, and it can generate loans and take deposits all over the country, right? So this is the dual banking system. This is a particular feature of the US. Not a lot of countries adopt this. Usually, most countries have one single chartering system where you want to be a commercial bank. There's a single licensing mechanism where you go get a charter and you're allowed to operate within the confines of that country. But the US, as an artifact of history and how states so slowly got incorporated into the union, started off with most banks being carrying only a state charter, and slowly over time, once the bank grows sufficiently large in size and it wants to expand beyond its own state, that's when you go and apply for the federal charter and try to expand the bank that way, right? So the Federal Reserve, which is a central bank in the United States, it plays, as we discussed, this is crucial role of the lender of last resort, right? So the lender of last resort mechanism basically means that when banks are distressed and they have nowhere else to turn, they turn to the Federal Reserve, and the Federal Reserve has this window which is known as the discount window, where you can apply for short duration loans which are collateralized against the bank's assets, and you can tide over for the short term, right? Before the Fed existed, banks were constantly subjected to bank runs. We've discussed this history of bank runs in earlier sections, but when you have many banks simultaneously experiencing a bank run, that's when you have a problem, right? Because a bank run basically is a crisis in confidence, right? A bank run starts with maybe a small rumor, maybe it's real, maybe it's unfounded. You don't know that the bank doesn't have enough cash in order to service its customers, right? So everyone wants to go pull out their money because everyone is fearful that the bank might go under, and then what would they do? And then if this news starts to spread and the contagion starts to spread to other banks, you have full-blown bank panic. And under the pressure of this bank panic, banks used to collapse quite often, right? A temporary liquidity crisis where the bank is short of liquid cash but is fundamentally sound. We've discussed this again previously. There's difference between an illiquidity and insolvency. An illiquid bank is not necessarily an insolvent bank, but an illiquid bank which is subject to a sustained bank run will more or less end up being insolvent pretty quickly because it's forced to sell assets at fire sale prices, which means it starts to realize real losses on its balance sheet. And then you can turn a liquidity crisis into a solvency crisis if it's not mitigated in the, if you don't cut off the bank run right at its core, right? So the Federal Reserve, after this, we'll get into it, the 1907 crisis. In the aftermath of the 1907 bank run, the Federal Reserve was created in 1913 with this express purpose of being the lender of last resort. So if you're a bank and you have a liquidity crisis on your hands, you tap the Fed opens a discount window, makes a short-term loan, so you can tide over your liquidity crisis, and your bank is, as long as the bank is fundamentally sound, nothing else happens, right? The other key part of this entire regulatory framework is the FDIC. Right? FDIC comes much later, somewhere around 1954, if I'm not mistaken. 1954. This is an innovation which comes in the aftermath of the Great Depression. Right? Instead of the Federal Reserve being constantly pushed into the frame every single time a bank is undergoing a crisis, uh, a decision was made that banks collectively should help each other out. And an insurance program was created where every bank, which has either a state charter or a federal charter, makes insurance premium payments every single month into this common pool of money. And if any of these banks experiences a bank run or there's some kind of a crisis with that, that pool of money is used to make the depositors whole. So the Federal Reserve doesn't have to constantly step in and put out these fires, that banks can self-regulate in that environment. So between the FDIC and the Federal Reserve, basically bank runs have disappeared in the US. So if you look at this history here, we have it from 1960 to all the way up to 2016. For most of this period, there's some bank failures. I mean, banks are run as businesses, so you're going to have some banks fail here or there every single year, like small community banks and credit unions might fail every year, but there's no widespread bank run, right? The two exceptions to this feature are obviously in 1985 to 1990, the savings and loan crisis, and then 2007, 2009 during the financial crisis. Okay. So in the early 1900s, if you think about the history here, most banks were prohibited from crossing state lines. This was to make sure that banks were rooted in their community. So this is a time when credit scoring is not a widespread phenomenon. There's no credit scoring mechanism. So how do you police credit risk, and how do you police a community, and how do you make sure that your loans don't go bad and people don't take a loan and stop making payments? You keep the scale of the bank quite small. You stay rooted in the community, people know each other, and you get a feel for who's a reliable bet, who's not. And that's basically how banking operated for uh, most of its early history, right? So in 1900, only of the about 12,000 odd banks in the US which had a charter, only 87 of them were federally chartered. The rest were all carrying state charters. So they're all geographically confined to small areas. But these restrictions began loosening up by the mid 1970s, right? So the Interstate Banking and Branching Efficiency Act, this was Richard Neal's brainchild, made it easy for banks to cross interstate lines and establish branches all over the um, country, right? One, the road to hell is paved with good intentions, but the basic idea here was that they wanted banking to basically spread out into rural areas, right? For you to take banking into the rural area, you need economies of scale, right? You need like your branches to be located in major cities, and the transactions you do in major cities are used to finance these smaller banks that you will open up in rural communities. And you need a scale. You need to be operating on that kind of scale where you have many branches in major cities and use some of those profits to run less profitable but crucially vital services in rural areas. And so the regulations were loosened up in order to allow big banks to operate on this scale, so that more and more people would be brought into the banking system and would have access to credit and all the rest of it. Okay, but the flip side to it is the problem we've already seen described as too big to fail, right? It could get to the point, as we saw in the 2007-9 crisis, that banks can get so big that they become structural to the entire financial system. And if one of them shakes loose, the entire system can come down with it, right? The big reason for the Federal Reserve and the Treasury to step in to rescue the entirety of the banking system, right? If you consider banks to be just like any other business, a business, if it does poorly, it takes outlandish risks, and it fails on its own merits, right? There's nothing else to be done about it. But when banks take on outlandish risks and carry a lot of risk on the balance sheet, dial up the leverage, chasing returns on equity, and they get into trouble, the problem now that we face is that we can't let the bank go under, because if we let one of them go under, all these banks are so interconnected that each of them owes each other so much money. Their balance sheets are so interconnected that it has this domino effect. The one bank falls, and then its counterparty falls, and then its counterparty falls, and pretty soon the entire banking system collapses, right? So even though the regulations were loosened up in order for banks to operate on the scale so that banking would be more widespread, it leads to this other big problem of banks getting too big to fail. Okay, so here's what the story looks like between the top 10 banks of the US. This is data from the FDIC, right? This data might have changed a little bit by now, but roughly still, yeah, I think roughly it's still fine. This is a little dated, the data, but if you pull the most recent data, I'm sure the trend is not particularly different. But the thing to take away from here is the level of consolidation that has happened in banking industry, right? So in 1900, we talked about over 12,000 commercial banks in the US, right, where they were practicing what was known as unit banking. One branch, one bank, you operate from there in that community, and that's it. Cut to 2015, this is when the data was collected for this. The top 10 banks in the US account for 53% of all the deposits, right? So there is massive consolidation. Again, if you look through the history, there's a lot of mergers and acquisitions that happened in banking between 1994 to about 2007. Bank of America, which started off as a small regional bank in North Carolina, became the largest bank in the US in the space of 15 years, right? So, Bank of America has 12.1% of the total share of deposits today. It's the single largest bank in the US. JP Morgan Chase, Wells Fargo, Citigroup. Everyone knows the big uh, banks, but they basically, between the top 10 banks, it's not even the top 10, there's just a big three. Between JP Morgan, Wells Fargo, and Bank of America, they control almost 40% of the total deposits in the US. So when that is the scale of the operation, if any of these banks is allowed to fail, the entire system collapses with them. That is the problem we have on our hands with this too big to fail story. Okay. All right. So between 1960 and 2000, there's five key things which have happened, which are of interest for academics in general. These are things that if you're interested in doing some kind of research, uh, very fruitful avenues for research here, because not a lot of literature has been spun out of these ideas, though it's starting to develop right now. So between 1960 and 2010, we see, first of all, that banks raise a lot more of their lot more of the lot more of their deposits, not from checking account deposits, but from time deposits and negotiable certificates of deposits, right? And so far the explanation we have is that it's primarily driven by a wealth effect. But that still doesn't, there's a lot of unexplained variation. If you run those regressions, you'll see that there's still quite a bit of unexplained variation in those regressions. Wealth effect is definitely part of the story, but it doesn't explain all of it. So that's one thing to consider as to why this trend is strong and still holding, right? The second thing is that they have increased their borrowings using repurchase agreements. And this is not that hard to fathom, right? We discussed already at the start of this lecture why a repurchase agreement seems like a better way to conduct overnight transactions versus just tapping the federal funds market, right? With the repurchase agreement, you have a collateralized loan, even though it's a short-term loan, and it's collateralized, right? That you have some securities which are pledged as collateral, and they bought back the next day, and you may take a small fee for facilitating the transaction. That kind of makes sense. There is less and less reliance on the commercial and industrial loan business. Okay, again, what explains this? Usual trends are, usual suspects. You look through the literature, are obviously globalization and capital flows moving out away from the US. Like, if manufacturing and the heavy industry moves out of the country, obviously loans servicing those industries are also going to come down quite significantly. And these loans, all these loans that were being made to, commercial and industrial loans, have now all been flooded into the real estate market. So we saw the dramatic rise earlier in this lecture. The real estate portion of the bank's loan portfolio accounts for almost 60%. And sometimes some banks, that's the average across the banks, which obviously means that some banks are even more reliant on these mortgages to keep their loan books afloat, right? And finally, the last big trend that we observe is that traditional commercial banking is no longer traditional, in the sense that these banks have taken on other lines of businesses. Now they all operate with different trading desks. They might have investment bank arms of their own. They might have other fintechs that they're either acquiring or operate under their umbrella. They kind of expand the rubric of operations that they take on, because commercial banking itself is not as profitable as it once was, right? All right. So there's one quick thing that I want to mention, which kind of gets missed here, is that, you talk to most people and they would say, okay, how do I judge the financial viability of a bank? And the short answer to it is, obviously you take a look at the balance sheet, right? Now, once, it's not just about looking at the numbers and making sure they all work out or whatever. It's about, calculating some key ratios, looking through what kind of assets that the bank owns, what you run some duration analysis, do a little bit of gap analysis, do all of those things. And obviously that gives you a fairly reasonable picture of the bank's financial health. But there's a wide array of activities, what the so-called off-balance sheet activities, which the bank enters into, but they're not reflected neither on the asset side, but more importantly, not on the liability side of the balance sheet, right? So one arrangement like this is what's known as a standby letter of credit. Okay, a standby letter of credit is basically, a merchant comes in, they need a loan, but they don't need the loan right away. Okay, if a purchase agreement comes through and they need to finance a transaction, that's when they need the bank to release the money. Up until then, the merchant doesn't want to borrow the money, and the bank does not lend the money, but they've issued this letter, the standby letter of credit, saying that if and when the purchase order comes through, the bank will give the merchant the credit in order to finance the purchase order. Now, this is reflected nowhere on the firm's balance sheet, but these credit letters of credit have been extended all around, to a lot of different merchants, and at any given point in time, these can start to get exercised, right? So even though the balance sheet gives us a representation of the bank's activities as a snapshot, there are a lot of other activities which are much more profitable, because if you think about letters of credit, LOCs, uh, uh, you know the nice feature to them is that banks can charge fees on them, right? So a merchant comes in and they say, I want this letter of credit. The bank says, okay, this is our fees for issuing a letter of credit. You collect the fees. You have done nothing, right? You just issued a letter on your bank's masthead saying you will issue credit if the purchase order comes through. But in the meantime, you just keep collecting fees and the bank's profits seem to rise and rise, even though there's no change on the assets or the liability side of the balance sheet. And this is pure profit. This is pure return on equity. And banks are incentivized to, bank managers are normal people. Their incentives are that the compensation depends on the profits that they generate for the bank, and you have a problem, right? So again, when you do forensic accounting and you run through these all the other things that the bank does which are not reported on the balance sheet, it's important to take into account uh, whether the banks engage in significant off balance sheet activities as well, OBS. Loan commitments, again, similar story. Bank commits to make out a loan, but again collects fees on it. But until that loan agreement is triggered, it's not reflected on the balance sheet, right? Trading activities. So now most commercial banks now have trading arms, so they generate a lot of profits by facilitating trades on the stock market. So they might have investment advisory firms, they might manage retirement accounts, they might do a whole bunch of other things. But one thing which used to be a very problematic feature of all of this was this practice which was known as proprietary trading. So with proprietary trading, commercial banks, what they would end up doing is that they would mix up depositors' money, which is under their commercial bank charter, right? And their trading arm, right? So they would mix depositors' money with their own money, with money they're taking from other investors for their trading business, and all of that would be in the same pool, and they would use that to trade on the market. And if the losses on that book are quite severe, they not only affect just the trading arm of the bank, they bring down the commercial banking side of the business. And that's where depositors, small time depositors get hurt, right? So Dodd-Frank, which was passed in 2010, basically was passed to outlaw this practice of proprietary trading. So if a commercial bank now has a trading arm, that needs to be treated as a separate subsidiary entity, and all the trading that happens on the trading desk stays within a separated, there's notion of a Chinese wall, right? That one part of the business doesn't know what the other part of the business is doing, and separate accounts are maintained, and the depositors' money is kept separate from the trading desk, right? So, that Dodd-Frank is a much more exhaustive bill than that. If you're not aware of who Dodd-Frank are, the Frank is the more famous one. Barney Frank was a representative from Massachusetts, the first openly gay representative to serve in Congress. He retired like a couple of years ago. So, he has a lot of minor but significant contributions like this in banking regulation. So if you're interested, you should look up his regulatory history. It's quite fascinating. All right. The last thing we'll do here, we'll talk quickly about the financial crisis, TARP, and what came as a response to all of this. Okay. So we already talked about the onset of the financial crisis. Mortgage-backed securities, the default rates on mortgage-backed securities started to rise. Banks were overexposed, as we now see, to the commercial and consumer real estate market. And these mortgage-backed securities that these banks were invested in began to decline in value, right? So as the market for these mortgage-backed securities froze, it became very difficult to figure out what the accurately price these assets, right? That's the crucial thing about a financial market, is that you can mark to market, as we say, these assets, which is to say a financial market allows us to do what we call price discovery, right? If I need to know the value of something, I need a market for it to exist, for me to go into this market and say, I have this object, how much is someone willing to pay for it? If the market doesn't exist, I don't know what the value of the object is, right? That's the crucial information that the financial market provides. So when you have a crisis in the mortgage-backed security market, price discovery becomes impossible. You don't know the value of all these mortgage-backed securities that you own on your balance sheet, and they become the so-called toxic assets because no one wants to touch it, because no one knows what it's worth. Right? So in a situation like this, where most of your loan book is comprised of, first of all, loan, obviously most of your bank's assets are comprised of loans, and if most of these loans are mortgage-based loans, and most of these loans are in the form of mortgage-backed securities, and you can't determine the value of a mortgage-backed security, you can't understand the balance sheet of the bank anymore, right? It doesn't make fundamental sense as to what the numbers are. You can't trust the numbers on the balance sheet anymore, and that uh, given that you're under this kind of balance sheet pressure, banks do what banks do. They want to cut their risk, right? They respond by cutting back on how much lending they're doing because they want the markets to stabilize for them to get a handle on things. But as they start to cut back and they start to tighten credit in these markets, these are already distressed markets. More and more mortgage-backed securities start to fail, and then you have the classic asset bubble collapsing, and the crisis is full blown, right? So we've already talked about this before, but the response from the federal government was to launch this massive rescue program of the financial system, which was called the TARP, which is a Troubled Asset Relief Program. The first tranche of it, something like $797 billion, was signed by President Bush just as he was leaving office, and then the uh, rescue efforts were further accelerated when President Obama took office in 2008. But what TARP was designed to do was to inject liquidity into these distressed banks by the government taking ownership stakes of these banks, right? So when you hear all this talk about socialism and nationalization of banks, this is basically government intervention, right? This is direct government intervention stepping in and becoming part owners of the bank, right? Because it's the only game big enough left in town, right? If one bank is distressed, you can turn to another bank and maybe they can bail you out. If two banks are distressed, maybe you find a bigger bank and maybe they can bail you out. But if every single bank in the country is distressed, then what do you do? There is no one big enough in order to rescue this. The only game left in town is the Federal Reserve, the Treasury, and the US and the government, right? So that's what they did. So within the TARP and the CPP, the Capital Purchase Program, the US government basically took over massive ownership stakes into these banks. And here we have kind of a list of the amount of money which was pumped into each of the big banks. JP Morgan, Citigroup, Wells Fargo, each of them were given $25 billion in exchange for equity in their firm. Bank of America, Goldman Sachs, Morgan Stanley, each of them got 10 billion in order to bail them out, and then PNC, US Bank, and so on and so forth, right? So this is all data. If you want to, if you're interested, the Department of Treasury has all of this data, and they also have data on when the banks repaid and how much interest was paid on these loans, and when the banks became again wholly privately owned. It took a while. Some of these banks obviously paid off much quicker than other. Goldman Sachs got off the program, and within 3 or 4 months they had paid back all the money they'd taken, and then regained control. But other banks like Citibank continue to have like a strong government presence for many years after the crisis, because their mess was unimaginable to be uh, that it took a while for them to unwind all the toxic assets that they were exposed to on the balance sheet. But we'll get into more of these details once we get into the financial crisis portion of the course, but I just want to allude to it in this um, context, because it kind of makes sense now that you understand the trends that we've been seeing in commercial banking. The fact that the US government the regulations will loosen, that the US banking system went from a unit banking system into these economies of scale, where there's massive consolidation in the banking industry that turns into this too big to fail problem. This is exacerbated when the bank's balance sheets are overly leveraged, right? Because these balance sheets are overly leveraged, and they're leveraged into the mortgage-backed securities market, and a small tremor in the mortgage-backed securities market sets off a cascading chain of events that basically unfolds into the worst economic crisis we've seen since the Great Depression. So, in a brief, in like the 30-second elevator pitch of the financial crisis is that, but the details are just as fascinating. Okay, so that's what we'll finish this session with. So that's basically all I want to do with the economics of banking. So in the next session, we'll turn our attention to the Federal Reserve. The following session is about monetary policy. And then the last two sessions of the course, we'll talk about financial crises, panics, and manias. Okay. So that's it. So as usual, if there's any questions, leave them in the comments below the video or send me an email. I'm happy to help. The homework is due at the end of the week, and I'll see you in the next one.